Welcome to Subramani. I'm going to talk a little about volatility and how people react to it. So let me give you an example. I think March, April 2020, the Franklin Templeton had an issue with its bond funds. There were two ways to react to it. Suppose you had money. I had my own money invested in that, and I've said this in the past also, and I realized that it was more a liquidity issue, not a solvency issue. I was not afraid that my money would be lost. I was sure that my money would be stuck. I didn't know that it would be stuck for 3 months, 6 months, 1 year, and I knew the fund manager had the competence to get it back. So I was reacting very, very rationally. But not everybody reacts so rationally. Here is the case of a professional. He's about 65, 66 years of age. And when he heard this news item, his first reaction was withdraw all the money from Franklin Templeton. It didn't matter to him whether it was in equity or debt, because he, not a finance professional, was convinced that there is some fraud which has happened, because of which the money was threatened. So first step, remove all the money from all the Franklin Templeton funds. Second, remove money from all credit risk funds, and remove money from any fund where there could be risk, which means there was AA paper, so he removed the money. So here, April or May 2020, he removed all the money from wherever he could remove, and he sat in cash. Now, if you understand the markets, April 2020 was not the best of times to remove money, definitely not from the Franklin equity funds. Maybe from debt fund it wouldn't have mattered, but that is what this person did. And obviously his losses because of this move, which he will not admit, but I have a very rough idea of his portfolio. I asked him for more details about what he removed. I think is about, at least in terms of Indian rupees, it's about 1 crore plus. Does it matter? No, for him it does not really matter, because he's a rich guy. He's got a lot of money and he punches way below his weight, right? So let's say he needs another 2 crores for his retirement. He's continuing to earn money. He's a professional. So it doesn't really matter. Even if all his money was in bank deposits and he paid tax, it wouldn't have really mattered. But this is what he did. And so I realized one thing, that the market will do what it has to do, but ultimately the impact on your portfolio depends on what you do. So typically January has not been a very great month for equity, especially if you are in US equities. You've seen a lot of violent fluctuation in the market. So what should you do? So let me split it into 3 parts. One is you're young, you've just started investing, you invested in the US market maybe in say September, October, and so a lot of your gains has been wiped out. You're almost in negative territory, but you're only 23, 24 years of age, so it does not really matter. So the most important thing for you to do is continue your SIP and perhaps wait for some time before the RBI opens up. Till then you can't do anything. But if your SIP is on, then just let it go, because you don't have to do anything towards that. That SIP will go on, whatever it is, 5,000, 3,000, 8,000. So there is nothing really for you to do if you are a very young investor and you have a long accumulation phase, right? You've got another 30 years to accumulate. But this is not the money from where you're going to meet your, you're going to buy a motorbike next year. Maybe no, maybe after 5 years, maybe the US market has had a fantastic long run over a period of time, and this is a time for some correction, some consolidation, some coming down, going up, all that can happen. Now cut to your age of 40, 45, you're still in the accumulation phase and you're far away from withdrawal, so you don't really have to worry. And don't think only of the US market. There is no reason why a similar thing can't happen in the Indian market. Why in the Indian market can't fall 20%? We never complain when the market goes up by 20%, so why should you complain when the market goes down by 20%? So if the market goes down, again, that is good. Embrace volatility. The market will recover. Now the problem is, many of us who have been in the markets for long know that every recovery need not be V-shaped. So 2008 the market fell and in 2009 it recovered, but it is also possible that in 2008 the market falls and recovers in 2013. So what happens if the market falls in 2022 and recovers in 2027? What you have to do is the next 3-4 years when the market is down, just nose to the grind and keep on doing your SIP. It's difficult. It's difficult to watch your portfolio fall and at the same time continue investing, especially in a social media driven world where everybody is going to tell you, oh, I told you you should have removed some of the money and kept it in liquid fund and then reinvested through an SGP. All that in retrospect, right? Today what to do? Should you be in cash or should you be investing? Well, if you have a 15-20 year time frame in which you are accumulating, there is nothing else to do. You can't take that money and keep it in cash and hope that you will enter after the market recovers or things like that, right? So there is a Tamil saying which says it's like waiting to take a dip in the ocean after the waves have stopped. Waves won't stop, volatility won't stop. So continue your SIP. Now what happens if you are 60 years of age? 60 is a very important cutoff, which means I'm assuming that it's after 60 your income from activities stop. Right, your income will continue. You'll continue to get your bank interest, your dividend, your if you do some equity trading, capital gains. If you sell some equity which you have been holding for a long time, then long-term capital gains. All these things will happen. Maybe all those things, all that income will come, but your active working income will go down or has gone to zero already. Then you might be a little worried about what happens to the volatility. But believe me, it still doesn't matter at 60. That the market fluctuates, assuming that you have got your asset allocation right. Yes, if you're 90% in equity and the market falls 20%, then yes, your overall portfolio is going to fall by 18%. Now the question to ask is, do you have the stomach to take a 18% fall in your portfolio? Now 18% doesn't sound to be very big. When you have a portfolio of 1 crore, it means 18 lakhs. But when you have a portfolio of 10 crores, it means almost 2 crores, 1.8 crores. So two questions. One, do you have the stomach to take the absolute fall? Do you have the stomach to take the relative fall, right? So the absolute fall, when you see 3 crores fall in your portfolio, you've seen your portfolio at 10 crores, suddenly you see it at 7 crores. Do you have the stomach to take a 3 crore? Maybe your requirement is only 4 crores and what you have is excess, but do you have the stomach to take it? That's one question to answer. And what happens to you when you are, say, 85 years of age and this change happens in your portfolio? It is even more difficult for you to accept this, simply because you do not know whether you have enough time for recovery. So the question to answer is, do you have enough money for the next 2-3 years, 4 years? I'm assuming that it will be a 4-year bear market. If there's a 4-year bear market, do you have enough cash flow? Do you have enough money in liquid, ultra short bond fund, bank deposits to meet your expenses over the next 3-4 years? Then you don't have to worry even if you're 85 years of age. Yes, the recovery could take time, you could die before that, but remember, you have the cash flow. Now this professional whom I'm talking about at the age of 65, when I sat and reasoned with him, he said, no, there is some big fraud happened because of which the money is lost. There will be no recovery. See what this website says, see what that website says. He was completely disturbed thanks to all these websites who said 75% fall is possible, 50% fall is possible. Not a rupee was lost. I did not lose a single rupee in the Franklin Templeton debt episode. Yes, I lost liquidity because that money was going into the US fund, so I lost liquidity, but I did not lose anything else, right? So I did not lose my peace of mind, and definitely there was no logic to withdraw from the equity funds. In fact, that was a great time to be investing in equities because equities fell, right? So ultimately the market will do what the market has to do. The market will fall, market will rise. You have to decide on how you will react. Again, depending on whether you're 22, 42, 62 or 82, each person will react very differently. Now at 82 also, if you have enough money for the next few years, then don't bother. But when you're young, you should embrace volatility, not because there is going to be a V-shaped recovery, but because you will accumulate more units when the markets are down. So if the markets are down for 4 years, it's fantastic because your 20,000 rupee SIP will now buy much more than what it would have bought if the market was rising. So younger people should embrace volatility simply because it's going to give you more units, and you have to be worried about NAV only when you withdraw, right? When you're investing, you want lower NAV. So with lower NAVs, be happy. Be happy that the market is volatile, right? Those are the 2-3 things which you can do. So I would summarize like this by saying that you have to have your long-term strategy and your short-term strategy. Your short-term strategy tells you from where to remove money. So if you have been watching my videos, I talk about a bucket theory. So if your bucket number 1 is full and it has got enough money for next 5-7 years, remember that that is also in the growth plan. So that will also grow and you will be able to withdraw. You have dividend income, you have bank deposits, all together you have next 10 years expenses. Then you don't need to panic. But that want to panic, need to panic depends on whether you have a properly written down financial plan, because at some stage your mind will panic, right? So I keep saying this, that fear is compulsory. It will happen to everybody, right? You cannot say that you will not be afraid. You will be afraid. When you're climbing a mountain, you will be afraid. When you're walking on snow, you will be afraid. When you're in elephant territory and you're not very confident about your driver or about your jeep, you will be afraid. But whether you need to panic is something which you can decide, and that you can avoid panic by having a written down plan, sitting with your financial planner or your advisor or somebody senior whom you consult for your portfolio. It's always nice to have a dialogue and say, okay, this is what will happen if the market comes down, what I have to do. I anyway have enough money for 3 years, 5 years, 7 years. You need some listening post, somebody who will talk to you and give you feedback. That listening post of investing, that is lacking, and that is it is very hurtful to do that in the social media. Social media tells you things which definitely scare you. So don't be worried about those things. Have your own plan, have your written down plan, understand what you have to do, and also understand that the market will always be volatile, right? Volatility is part of the market. If you have not seen volatility for 3-4 years, and if you have seen a linear growth, and if you have seen V-shaped recovery, don't assume that the market will be linear. Don't assume that the recovery will always be V-shaped. It could take 3 years, 5 years. But remember, if I'm talking of a recession hit market to take 5 years to recover, you can reduce that 5 years to 2 years by aggressively investing more. That's all. That's the only thing that you can do. So for you, the recovery will be faster. That you did not take 5 years to recover, you took 2 years to recover because you continued your SIP and you got more units during a bad time. But again, let me say this, I've said this a million times, don't assume if there is a fall, recovery will be V-shaped. Recovery could be V-shaped, W-shaped, O-shaped, L-shaped, right? Any type of recovery. So give it time. And since you are young and you are in the accumulation phase, the one thing which you have a lot is time. So I keep saying 22-year-olds have less money, but they have they have time, because they could remove, they are investing for 80 years. But the 70-year-old has got money, but he does not have time, right? So he's got maybe only 20 years or even less than that, right? So two factors which make money for you. One is money, second is time. So all of us are rich. Either we have more money or we have more time. So see where you are, but having a written down plan, especially for older people, is useful, so that you make a note, keep it for yourself, and say, whenever there is a fall in the market by 5%, 10%, even 20%, I will read that note, I will talk to this person and keep myself calm, and I will not do anything which is pretty unnecessary. Like this person, professional who came out, there was no need for him to do. But the other way to look at it is, maybe he needs 2-3 crores for retirement and he has got some 16-17 crores. So what he did with about 5 crores of his money doesn't really matter. Yes, he lost 1 crore, but in his life, it won't matter. He will continue to eat, he'll continue to live, he'll continue to drive his cars. There is no problem, no change in life. But there can be somebody for whom this fall can be very hurtful if they have absolutely no plan or they have no clue how to react when there is a fall. So be prepared for a fall. I'm not saying the market is going to fall, but in case the market falls, you should know how to react. Thank you.